got myself, Mark Hewitt, as well as Sean LaBelle from the Decker Hewitt Group. And we've got the pleasure of speaking to Greg Huffman from Canaccord Genuity today. Welcome, Greg.
Thanks very much for having me.
Before we get started, I'm going to give a little bit of background on Greg. Greg's going to give you a little bit more, but he joined us in February 2016. When I say us, I mean Canaccord Genuity, as our global head of mining sales. Essentially what this means, and he can probably give you more detail, he speaks to all of Canaccord's corporate clients, institutional portfolio managers, et cetera, on where he sees the best opportunities to invest in the mining space. He publishes an extremely well-regarded daily sales note on the mining sector titled The High Grade Mining Minute. It's a mandatory read for all of us and anyone interested in the sector. I'll let him give you more detail on his background again when I'm going to pass the call over to him. We asked Greg to come and speak with us today to tell us specifically what he's seeing in the gold and mining sectors. Obviously, we're extremely interested in the space right now for some of the following macroeconomic reasons. With COVID-19 global slowdown, economic uncertainty in the world, and a massive monetary and fiscal stimulus, we have a similar backdrop to 2008-2009 global financial crisis, after which gold went on a 3-year surge to new highs in 2011, which we have yet to exceed. Even before COVID, though, it was obvious we were already in a high debt world with easy monetary policy. And gold helps provide protection from negative rates and money printing. Also provides us some diversification from the US dollar, which has been the principal go-to for safety, particularly over the past few weeks, although that's starting to give up a little bit right now. And with global supply of gold still being challenged and investor sentiment still relatively low, it seems now is a very good time to make sure we have some exposure to this metal. So with a bit of that background and context, I'm going to pass the call over to Greg now and let him take it away from there. Thanks, Greg.
Excellent. Thanks, Mark and Sean, and for everybody for joining this afternoon, depending on where you're at. I'm sitting in Toronto in the office. I've been working from home for most of the last 3 months, but I'm back in the office for a couple of days this week, just getting a few things tidied up. So thank you very much for the opportunity, as I mentioned off the bat. And I think we're in a very unique and exciting time for precious metals, but mining in general, just given the overall macro backdrop. As Mark had said, I'm the global head of mining sales for Canaccord Genuity, based out of Toronto, and look after the North American mining research team. Liaise very closely with the North American mining bankers, and then have a number of mining and resource-focused sales colleagues around the globe: London, New York, Vancouver, Singapore, as well as throughout our offices in Australia. So I sort of quarterback a lot of what goes on from that perspective on a mining front across the firm and public side of this side, and talk to the mining investment bankers on a very, very much a daily basis, just about what we're seeing from equity demand from our institutional accounts. We liaise closely with our wealth management groups, and just basically try to make sure that the firm is well aligned in terms of what's going on with the mining industry globally. So a little bit just on my background. I'm a geologist by training. Went to school in Sudbury, Ontario, and then worked for Falconbridge there for a few years before going out on my own as a consulting geologist. Worked a lot out through Northern Ontario, Northern Quebec. And then moved into the sell side a little bit by accident after I moved to Toronto to go back to school to start a PhD in geology, which didn't really enjoy, and so sought out the investment side of things. Worked as a mining analyst for about 5 years at a couple small boutique firms, then moved to one of my clients, a U.S. hedge fund out of Milwaukee, recruited me to come there and look after their initially Canadian metals mining through 07, 08, and then post 08, 09, moved from just Canadian metals mining to global materials. So did that until about 2010 when I moved to Scotiabank in Toronto to start up their mining sales franchise there. Did that for about 6 years. Short stint in investment banking at Scotiabank before I had the opportunity to join Canaccord Genuity in my current role. So basically love where I sit. I get to work very closely with the mining research analysts and really focus in on sort of where we want to be as a firm with respect to trends within the mining industry, which names we're covering, and then targeting which names we think are the best opportunities for our investors. So with that backdrop, I joined 4 years ago, as Mark mentioned, and I think the timing was really good because I could just start to see things, the light at the end of the tunnel, from a macro perspective with respect to after a long, very quiet period with respect to precious metals in general, but generally metals and mining. There'd been some M&A here and there, but it was really quite a challenging environment. What really started to, and Mark hit the nail on the head off the start of the call, we already had a very positive backdrop for precious metals, particularly heading into the prior to the onset of COVID, with budding interest and the financing window starting to open up. With increased interest from institutions globally. But really what happened with the onset of COVID was set up a scenario very similar to 2008, 2009. And having lived through that, working on the buy side at the time, it's really quite remarkable the parallels that we can see, and our mining research team out of North America, led by Carrie McCurry on the precious metal side, has done a phenomenal job of articulating those similarities. So I'd refer you to some of his research there, as well as Martin Robert's, our portfolio strategist for North America. Between the two of them, they've done a very good job of outlining a lot of the similarities, which I'll touch on briefly here. But what I'd really like to focus in on is where I see us in terms of the equity cycle for the precious metals and then mining in general. And I think we're still very much in early days in terms of the emergence of precious metals as a very viable investment vehicle for the generalist investor. And that's really, since the onset of COVID, and more specifically, once the U.S. government really started to basically open up the valve in terms of quantitative easing and basically unlimited amounts of cash available. That was when we saw a sea change in terms of investor interest, particularly out of the U.S. And lots of accounts started calling on Carrie and myself. And these are accounts that we have never heard from before. These are people who maybe looked at gold a little bit back in 2010, 2011, but then really disappeared from the sector or have never looked at gold. And we were really fortunate because one of the very first virtual marketing road shows that we hosted in the work from home environment was for Franco-Nevada in the Tri-Cities areas of New York, New Jersey. That really was an opportune time to shake the trees and see who is interested in precious metals, because really there's not a better vehicle than a large cap royalty company to introduce people into the world of precious metals investing, because very low risk environment, diversified across a number of assets in a number of jurisdictions, and very, very stable cash flow and an excellent track record of returning share share price performance, returning cash to shareholders via dividends. So that was something there saw big interest out of U.S. institutions on that roadshow, but we also saw very, very strong follow-on interest from our U.S. sales distribution team, because they could see that their clients are starting to ask for that. So on the back of that, we've probably been the most active investment dealer in terms of road shows through North America, as well as globally, for mining companies in a work from home environment, doing the virtual road shows. So, that was sort of I'll call it stage one of the current precious metal cycle, was basically looking to sell almost all risk assets. And initially, basically the risk assets included all equities. They included gold because it was a liquid investment. And so, right off the bat, after COVID onset, we saw gold actually pull back. And we pushed hard on that. And that was when we had Franco marketing and trying to make sure that our investor base was looking at the space, and starting to using that to get positioned. But it was a very scary time for a lot of people. So, some amounts of success, but combined with that, a lot of the large cap miners had their mines shut down And so there was a struggling environment at that point to get people to look at and put positions on in any of the gold equities. But that didn't last very long before we started seeing that stimulus start to come in the US, and we saw gold start to rally. And that's what I'd call stage two of the current market where we're in. And really, people start to look at gold as a viable investment class and take their weightings from zero or almost zero up to a higher level. And Kerry was incredibly busy fielding these inbound calls from a lot of the generalist investors, as well as some of the resource investors who have been, invested in long suffering. We're starting very, very, very early at that stage, but just starting to see a little bit of inflows into their funds. So that was step two. We started to come out in mid-March to late March of the mine shutdowns. That really opened up the large cap miners for investment opportunity. And people started to get a better handle that the mines weren't going to be shut down for an extended period of time, as most jurisdictions deemed mining an essential service. And so that's when we really started to see the rally move from the royalty companies into the large cap golds. And I'd say we're just sort of moving through that process now. Sort of the very high quality, low cost, safe jurisdiction global gold miners were the first ones to start to move higher. Now we're starting to see some of the more torquey names see increased flows, and that's kind of, so I'd say we're sort of at that stage right now. We've seen a little bit of M&A, but not a lot. And this is a really important differentiating factor versus 2008, 2009. A lot of people have talked about the similarities, but in 2008 and 2009, we started to see a lot of M&A, and we saw rampant cost inflation in parallel with the increase in the gold price. And that's really what cut the rally off in terms of the gold miners. This time, we're not seeing that cost inflation. If anything, we're seeing cost deflation because of current energy prices. So it's really it's the best of both worlds for the gold miners right now. So we expect them to see record free cash flow margins, very much growing the cash on the balance sheets, reducing debt levels to, basically we see 80% of the sector being in a net cash position by the end of this year at current gold prices. So in 2008, basically once the gold rally started, we started to see a lot of these gold companies, seniors, juniors, mid-tiers, all come to market to recapitalize their balance sheets. That doesn't need to happen this time, because for the most part, the balance sheets are already in very good shape and are going to be moving in net cash. So we really look to see companies, and we started to see this a little bit with the recent Q1 results, ramp up their dividends, start to initiate share buybacks, just because of the huge amounts of free cash flow that they're going to be generating. And that's really what's drawing a lot of the generalist investors in and starting to look at gold, not just from a gold equity investment, not just from a macro perspective, but comparing it to other businesses, because it can hold its own from a free cash flow yield perspective. So that's something where I think we're still in early stages of people starting to increase their weightings in gold. And we expect there to be continued share price appreciation of these mid-tier and larger cap gold names. Where we're going, and what I like to refer to as, you got to go to where the puck's going to go, is the smaller cap gold names. Because basically, from a mining industry perspective, mining's like a good analogy is mining's like a bucket with a hole in it. Every day, gold miners and miners in general take resources out of the ground, but they're not, those resources aren't replaced. You have to go out and find those resources, either near mine or go out and find new mines that can be built. And over the last 10 to 15 years, there's been very, very minimal investment by the mining industry in exploration, which is equivalent to R&D for a technology company. So really what's happened is a lot of these companies have these great free cash flow profiles for the next few years, but the sustainability of their businesses at the current production levels is in question more than 4 to 5 years out. And so that's what really drives the big share price appreciation within the mining sector, which comes from the single asset producers and the junior development and exploration stage companies. And we really expect that those ones are going to be become very much M&A targets from the larger cap companies that are going to start chasing growth and sustainability of their current production profiles by adding on new mines within their portfolio and new resources which they can develop into the future mines. So that's still to come. We haven't seen that start to play out. The junior sector, the junior development sector has very much lagged, as to be expected to this point. They're smaller cap companies, they're challenged on liquidity, and really the early money in is looking for the larger, more liquid, immediate exposure to gold. So maybe I'll stop there for right now, and we can see if there's any questions, or I can continue on, Sean or Mark.
Yeah, Greg. Maybe before we get into the Q&A, maybe to get your thoughts on the base metals out there, state of copper and such.
Yeah, absolutely, and that's actually an interesting point, because we talked about initially about the U.S. dollar and how the U.S. dollar rallied as a sort of flight to safety, and now with the amount of U.S. Stimulus packages being thrown at the market and the broader market starting to rally and the U.S. dollar starting to roll, this is playing out just sort of as Carrie and Martin and the team has expected. So we do expect further weakness in the U.S. dollar. That's going to be good for gold, but it's going to be good for all U.S. dollar denominated commodities. Generally what happens, gold moves first, then we see a brief rally in silver, because the ratio between gold price to silver price blows out. Gets way out of whack, and then people start to sort of chase silver names as torque to the precious metals that hasn't moved as much yet. So usually we see a violent move in silver and silver equities higher. That's happened here over the course of the last couple of weeks, aided by a lot of commentary by people like Eric Sprott, who've been investing in a number of silver producers and developers. Following that, usually we see a move into the base metals, and copper generally moves first as the largest, most liquid of the base metals markets. And interesting, because obviously we're in a time of great global macro uncertainty, with uncertain timing of economic restarts. But even despite that, the copper market is incredibly tight from a physical perspective right now, probably as tight as I've seen it in the last 8 or 9 years. So that's something where I think the copper market is a bit of a sleeper right now. We're just starting over the course of basically this week, starting to see institutional investors move back into copper in a bigger way, and look for sort of through the current shutdowns, because a lot of those copper mines are just they're bigger and they take a little bit longer to restart. Plus, some of them are in jurisdictions that have been hit quite hard by COVID. So those copper mines, and that's just accentuated the current tightness in the copper supply. And so we expect the copper names to do quite well here over the course of the balance of 2020.
Okay. And then diving into some of the Q&A, where do you see this pandemic affecting the production deficit for gold and silver? A number that was kind of thrown out initially seems to be around 3%. Is that accurate?
Yeah, I think that was an early number that was thrown around. I think actually it'll probably be a little bit less than that. What we've seen is basically a lot of the companies be able to start back up quite rapidly. And remember, there's a lot of flexibility in terms of these companies within their various mines to mine higher grade in order to meet their budgets, and a lot of them are looking at that right now. And we've seen most companies suspend guidance. However, early commentary from these companies as they start to ramp back up is very few of them think they're going to have material declines in terms of their full year guidance. So I actually think that it's going to be a little bit smaller than that 3%. And particularly for gold and silver, the base metals might be a little bit harder impacted, but for gold and silver, I don't really think that there's going to be a big pullback, and it won't. The current rally in gold price is not really going to be supply side driven; it's much more on the demand side.
And then, what would you use for a discount rate for a mine right now? We're obviously in a very low interest rate environment. Previous discount rates are 10%. That seems a bit excessive.
Yeah, and that's a good point too. Having been an analyst as well, and our analysts and analysts at other firms do a very good job of looking at the companies. But one thing that they don't do is really flex their discount rates very much. Generally, for precious metals companies, it's a 5% base case discount rate, and then they'll layer on higher discount rates for either jurisdictional or operational specific risks. So you can get generally somewhere between that 5 and 8 to 9% is typical for precious metals. Base metals, 8 to 10% is sort of where things are there. But yeah, I think that's generally accepted practice. But is it appropriate? I think right now we could argue, an argument could be made, from a cost of capital perspective, could be much lower. And remember, these companies all have very, very strong balance sheets as well. So they're really not balance sheet constrained right now. What they're going to be constrained is on their available resource base.
And then diving into the company specifics, we got a question here on Ivanhoe. Will the capacity and cost of that project in Congo marginally or largely disrupt copper price as a whole in the market here going forward?
Yeah, I don't. You know what? It's a phenomenal deposit. It's really something that's quite unique globally. However, and it will become a very material supplier. However, we need it. So I don't think it's actually going to disrupt the supply side. I think it's going to actually replace the decline in production driven by the falling grades, particularly of the mines in South America, which, average grades now are well up below 1% copper. So we need Ivanhoe's Kamoa-Kakula project in DRC to come on just to fill the decline in production profile. So to meet, growing demand for copper. So I don't think that's going to be a problem or a cap on the copper price. I think if anything, if there's any delays in that project being on, it could actually, related to geopolitics in DRC, it could actually make set up for a even larger spike in the copper price.
And then maybe some names you like both on the gold and copper front across different exploration spectrums.
Yeah, absolutely. Maybe I'll start, at the royalty end of the spectrum, and work my way through to the exploration developer companies. So if I start at the large cap, obviously Franco-Nevada is a go-to name in the royalty space. Or if people think of precious metals investing in royalties, Franco's sort of the go-to. Wheaton Precious, we're the inventors of the streaming model and has become a very large competitor, and does trade at a bit of a discount to Franco. However, Franco still remains that sort of immediate go-to status, with Wheaton as sort of the number two. But I would want to highlight another one that we really like, and it's actually Kerry McCreary's top pick in the royalty space right now, is the Cisco Gold Royalties, ticker symbol OR. And it's actually trades at quite a meaningful discount to the other royalty companies, because they've got a little bit of a blended model versus sort of the pure play royalty and streamers. But we think that discount that it trades at is just too large right now. And so that's one that we think there's a really good opportunity for a catch-up trade on. That's on the royalty side. If I go through the senior producers, Kerry really prefers of the large caps Newmont. I agree with him there. I think Newmont's an incredibly well-run company. It trades at a bit of a discount to Barrick. It's got a diversified production base, and it's got a very, very good growth profile relative to some of its peers, which is something that I would highlight as definitely a differentiating factor. Other ones on the large cap side, we talked about, so the royalties is sort of the initial focus for investors, and some of the large liquid producers, and then moving into the torque gold producers. In that category, I'd highlight Kinross Gold, B2 Gold. Those are both names that are very, very strong operationally, great resource bases, and decent production profiles, and that have just been executing year in and year out here for the last number of years. So those ones we like. If I move down to the smaller cap producers within the gold space, we really like Centerra Gold. That's covered by Dalton Barreto. Centerra Gold historically trades at a large discount to its peers because its principal asset, and for a long time its only producing asset, is the Kumtor mine in Kyrgyzstan. But that's very much changed over the last few years. The company's worked hard to diversify and add in additional assets, both in Turkey as well as Canada. So now it's much more diversified, and we think that valuation gap will generally start to close. And that's Centerra Gold, ticker symbol CG. Also would highlight Dundee Precious Metals, also covered by Dalton Barreto. This is one that has the largest free cash flow growth within our coverage universe right now. Assets in Bulgaria. So again, that's a jurisdiction that historically has been a little bit challenged for investors, but the company has a very long and good operating history there, and has just completed their second mine in country, and is basically set to generate a lot of free cash out of its two assets there. Good copper byproduct exposure from that company as well. And then finally, out of this group, I'd highlight Teranga Gold, ticker TGZ. Covered by Kerry McCreary. They're focused in West Africa and have an operating mine in Senegal and then a new mine in Burkina Faso. They've done a recent acquisition late last year of a Barrick asset called Massawa, which basically dovetails incredibly well with their current operating mine in Senegal. So that's going to be something where we see a very big re-rate potential as they bring that mine on in the second part of 2020. Those are some of the producing companies. I don't know if there's any questions specific to those, or if you want to continue on into some of the developers or other copper names.
Well, there was a specific question that came in on Glencore's Mopani copper mine in Zambia. Maybe if you have a bit of added color or insight on that one.
Yeah, I'm not sure if there's a specific question or context around it, just thoughts on it. Obviously, Glencore is one of the largest global miners and a phenomenal trading house of metals and other commodities as well. Mopani's a very big producer. Zambia is a bit of a tough jurisdiction. There's a lot of politics surrounding Zambia. It's you've got phenomenal assets, and generally it's a longstanding center for mining. However, the government, there's been a lot of back and forth between the various mining companies operating in country and the government regarding tax rates, stability of power, and a number of other issues. So it's a big copper producer, but there's a lot of uncertainty associated with the country at the current time for both Glencore as well as some of the other producers like First Quantum, which again, that's the thing. We see a lot of supply risk in the copper market, which we think will contribute to higher prices.
And maybe that's good leeway into some of your preferred copper names.
Yeah, so I think from the copper side, there's not nearly as many names on the base metals universe listed in Canada as there used to be, or as relative to the number of gold names. So it's a much smaller universe. And again, if I look at the copper market right now, copper is currently $2.42 a pound. That's an okay copper price, but not a super strong copper price. So you want to generally stick to some of the companies that have lower cost operations and quite strong balance sheets. So Dalton Breda really likes Lundin Mining, ticker LUN. This is sort of the main go-to that people have right now for sort of safety within the copper space. If you're looking for more torque, people like First Quantum. That's the one when copper's having a big move, people generally trade into First Quantum. It's a large liquid name. We also really like ticker ERO, Euro Copper. They've got an operating copper mine in Brazil, quite high grade and an underutilized mill, but have an excellent land package and perspective for additional copper as well as nickel discoveries. So that's something. They've got probably the largest drill program globally happening right now, and we see very good potential for incremental success. And then finally, within the copper space, I'd like to highlight Capstone. Capstone is the torque name. It's a smaller cap name. They're quite highly levered from a debt perspective, but we see very good upside from this name. They've had excellent exploration success at the Cozamin mine in Mexico. Their Pinto Valley mine has done a number of operational improvements and debottlenecking that. So we really think there's a lot of upside for Capstone.
And then maybe last question, you talked about it somewhat before, but M&A multiples. Investors of past cycles will remember big takeout premiums. This go around, it seems companies are less inclined to make these flashy acquisitions. Do you think it's just a matter of time before that picks up, or is this fiscal prudence here to stay?
Yeah, I think it is going to be a little bit different this time. I think from an M&A perspective, I think the trend that we're seeing in the larger cap and mid-tier gold producers is merger of equals with little or no premiums paid, and basically you're just stripping the incremental G&A. out of the sector. We expect that to be a trend to continue in terms of decreasing number of names by consolidation. Where I think the M&A is really going to happen is, as I mentioned before, is the mid-tier and larger cap companies buying some of the smaller single asset producers and development stage companies. I think that's really where you're going to see a focus on the M&A, and that's where you'll see the premiums paid. And I expect that trend to continue, and if not accelerate with rising gold prices.
Perfect. Mark, any other commentary?
No, that was a really good overview. Thanks, Greg. Anything to
Absolutely,
wrap up
guys.
with for your chat? Anything?
No, just do a little bit of an advertisement for the Canaccord Genuity mining research team. I think we've probably got the one of the largest as well as strongest teams on the street right now in Canada. But also don't forget that we've got a very our team in Australia. We have 5 publishing mining analysts there as well. So anyone who has an international mandate and looking at the names would definitely refer you to our Australian mining research and sales team. They're excellent and are leading the league tables right now over in Australia.
Great. Thank you, Greg. I'll reiterate that Greg's mining team and the mining team that we've built, that Canaccord has built over the past number of years is phenomenal. So we're excited to actually see a solid mining market for a while, which we haven't had for some time, although it's been a good start to the year. So with that, thanks everyone for listening and watching today. I'll give you a quick overview. We're going to have Dwight D next week from Miller Thompson giving us an overview of living wills and specifically incapacity planning, which is kind of a bit topical right now. So if you all can make it, we'll send out the details shortly. Hope you all can tune in. Cheers. Thanks, everyone.